welcome everybody to this event. My name is Marcus Brunnermeier. I'm the director of the Bentham Center for Finance. And it's my pleasure to introduce and welcome Atif Mian, my colleague, the Theodore Wells Professor of Economics and Public Affairs here at Princeton and director of the JRC PPF. Atif joined about 2 years ago at Princeton, and we all read in the faculty his research. We were very impressed. And that's why he came to us. And now he thought he will make his research more open to a broader public, to a broader audience, and that resulted in the House of Debt. And soon, actually, he will go on a global stage, to the global stage, and actually it will be translated in various languages, in Chinese, Japanese, Korean, and also German, I was told. His book was also praised by the leading columnists of the time, Larry Summers, Martin Wolf, Paul Krugman, and so forth. He was one of the 6 top biggest business books in the Financial Times, and Politico listed him as one of the top 50 political thinkers, doers, and dreamers for rewriting the narrative of the Great Recession. So I think that this will be a great event, and he will walk through the book and give you a little bit of a teaser and what will it be about, and you should all buy it afterwards. There will be a chance to do so, and you will get it with a handwritten autogram. That's a special treat. And this will be after the Q&A, and for the Q&A, I think the students should have priority to go to the microphone and have the Q&A. And I don't want to stand between the speaker and you anymore, so then I will step aside, and the floor is yours.
Years at Princeton, and it's wonderful to get a chance to talk to all of you today. I'm going to speak for about 45 minutes or so, is that right? And then I'm happy to take any questions that you may have. So that's how we will proceed. I should make that announcement before we begin for the undergraduates. So one of the things I do at Princeton is that I direct a center, the Julis-Rabinowitz Center for Public Policy and Finance. And since I know there are at least some undergraduates in the audience, I wanted to take that opportunity to announce a new initiative that we have just started, which is an associate program for undergraduate students at Princeton. You can apply to the GRC, and Violetta, who's sitting here, she can give you more details. You can email her with a basic application. The point of the associate program is to help undergraduates at Princeton who are interested in this broad area of public policy and finance, to help them take their own initiatives if they want to start some events, do some research, to help them provide resources, and at the same time to help them meet with various academics as well as policymakers who come through Princeton, but we will also help them go to other conferences to meet such individuals. So that's kind of the broad idea, is to help encourage more thinking and research in this area for Princeton undergraduates. It's a new program. We feel very excited about this program, and I hope that the Princeton undergraduates take advantage of that. So that was a kind of a public service announcement. Now let me get into the purpose of today's talk, which is I'll talk about this book, which is obviously written with Amir Sufi, as you can see. We did not plan this book. This is really the culmination of about, I would say, 6 years of research that Amir and I started, luckily just before the Great Recession. And so we were looking as young professors, looking at the mortgage market that was kind of really expanding very rapidly in late 2006, early 2007, and we were wondering what's going on and what might be some of the explanations for this huge increase in debt. And as a result of those questions that we had in our mind, we got hold of some quite detailed data on mortgages and household borrowing in general. And once we got the data and we started looking at the data, lo and behold, the housing market starts to crash. And then the financial market starts to crash. And then the economy starts to collapse. And so we were very excited when all of this was happening. we knew we were looking at the right data. We knew there was going to be a lot of questions, and so we knew that now we are going to have a career, which we weren't sure of just a few months back. So, this was sort of a lucky break for us, and we continued looking at the various questions that we had in mind. Now, let me kind of give you a little bit of the philosophy of the kind of, the sort of the premise of the questions that we were asking. And before I do that, I should maybe also give you a little bit of background of why I chose to become an economist, or maybe why economics as a field really excites me every day. And this is why I love what I do, and I continue to do what continue to work in this area. I like economics, and there are many ways to answer this question, but one reason I like economics is that it raises some very interesting puzzles that deserve to be answered. And what we are trying to do in this book is trying to answer one of those puzzles. So let me present you with that puzzle first. If you're interested in the very basic question of what makes an economy, GDP, go up, and what makes an economy or GDP go down, there is one simple way of thinking about that question, which is that GDP at the end of the day is determined by the ability of the individuals living in a society to produce certain goods and services. And as a result, the more educated they are, the more capital they have, the more they can produce. That part is kind of very straightforward, right? So if you're more educated, if you have more sophisticated technology at your disposal, you should be able to make more airplanes, more cars, produce better software and so on, and hence make more money, right? That part we understand. The puzzle, however, is that there are many occasions in time when we see an otherwise healthy economy moving, and then all of a sudden the economy seems to have a serious problem, manufacturing or producing the same amounts of goods and services, right? This is what we call a recession. So otherwise, people have not forgotten how to make the products that they used to produce. Capital is still sitting, so you have the same factories. All the institutions are there. There is no big war that has taken place, and so on and so forth. And yet the economy tends to go down in a recession. People start getting fired, and the economy is not producing as much as it used to. If you look at it from that perspective, this is really a big puzzle. Why do economies slow down, and advanced developed economies slow down without any apparent reason to speak of? So this is one of the reasons that I find economics exciting, that this is a puzzle that really needs to be investigated. And so that was one main motivation that we started with when we did the work that is behind this particular book. Okay? Now, there are many ways of thinking about this question, but one aspect that stands out, and that really is the starting point of this book, is that when you're trying to look back at history and you look at these episodes of big collapses in the economy, and there have been many across the major economies of the world, one variable stands out. And not only does that variable stand out, but the other question that irked us was that this variable that seems to stand out has actually been kind of ignored in the macroeconomic literature. And so that's why we wanted to focus on this variable really hard and try to understand if we can figure out the connections of why this variable is often associated with recessions, and in particular deep recessions. So that variable, first of all, turns out to be debt. Okay, so this is the first point, the starting point that I think it's useful to keep in mind. Debt really matters if you want to understand the up and down nature of the business cycle over time in major economies of the world. And this is one representation of this fact. What you're seeing on this graph is overall household debt to GDP for the US over the past 100 years or so. Okay? And when you look at this graph, you see there are two big peaks in this graph, 2 points in time when household debt to GDP exceeded 100%. The first is around 1929, and the second one is around 2007. And we know what happened around that time. The first peak results in, or is at least followed by, the Great Depression, and the second peak is followed by the Great Recession. So that suggests that there may be some relationship between the level of debt that an economy takes on and subsequent slowdown in the economic process. And that's what we need to understand. So that's kind of the big question that we are trying to solve in this particular book. Now, this pattern that I've shown you, you might say these are just two data points, and of course they are just two data points, 1929 and 2007. But it turns out that this pattern that we are seeing for the US is not only true for the US, it is much broader. And so now I'm borrowing from another line of work which is done by Alan Taylor, Oscar Joda, and Sholaric, where they put together this kind of a data that I just showed you for the US. They put together this data for as many countries as they can get hold of and for as long a period as they can study, which is over 100 years of data. And they're looking at all the major advanced economies of the world. And what they find is that this basic pattern that you saw for the US, it's true not just for the US, but it's broadly true for all advanced countries of the world. So in particular, this is now sort of a technical graph, but the way to read this graph is that the red line refers to those recessions that are preceded by a big run-up in debt to GDP. Okay? And you can see that those recessions, which are preceded by a large run-up in private debt to GDP, they tend to be deeper. The red line goes down more, and they tend to be longer. It takes longer for the red line to go to cross the initial point at the x-axis of this graph. Okay, so this result that debt really matters is not only true for the U.S., but it holds much more broadly. And so the question is, why is that the case? Okay, so that's the basic puzzle that this book is after. Now, having said that, you might say, well, if this is so obvious in the data, why haven't people studied this before? To be honest, we don't have a real answer to that question. We feel it should have been answered before. I'll try to give some reason. I think one is that the kind of data that is really needed to answer this question has been available more recently. So people did not have as detailed a data as information technology made available to us. And that is one important, I'll emphasize this at various points in today's talk, that is one important element of our book, that it's really a data-driven book. And the kind of data that we use in this book really became available since the IT revolution of the early 90s. So perhaps that's one reason for why people did not focus on this particular question to the extent that we think it deserved attention. Nonetheless, one of the contributions that we think we are trying to make in this book is that we are trying to understand better how we should bring finance into the macro models that we use. Okay? Now, if you go back to the public debate right in the aftermath of the financial crisis in the US, you would notice a lot of commentators talking about the failure of economics as a field. Right? A number of commentators talked about macro models in economics not anticipating this crisis. But even worse than that, I think that's a little bit of unfair. It's not the purpose necessarily is not to anticipate crisis. But even worse than that, people were criticizing that the macro models actually have nothing to say in terms of what to do in the aftermath of a crisis. And that to some extent was true for at least some of the models. And the reason for that was that if you really looked at the kind of the basic macro model that was being used by central banks and others, those macro models often did not have much finance to begin with. And so if you went to those macro models and you asked the question, well, if I see a very high level of leverage in the economy and I see this kind of a financial crisis, how should we respond to that? Well, those models did not have those ingredients to begin with. And so it was kind of, they were silent by definition to those kind of questions. And so what we really need is we need to open up some of those black boxes in the macro literature and really write down the models that have those details that tell us the possible channels through which the financial markets can impact the macroeconomy. And that's one of the themes of the book, is to try to understand what those channels are that connect finance with the macroeconomy. Now, let me be a little bit more specific in terms of what I mean by finance, right? People have different notions when they talk about finance, but in this book and in our research, we have a very specific definition of what finance is. We think of finance as the primary sort of function of finance is what we refer in more technical jargon as the process of intermediation. And from that perspective, since intermediation primarily is done through the banking sector in the modern world, what we are really talking about is the act of borrowing and lending, which is primarily done through the instrument of debt. So when we talk about how finance impacts the macroeconomy, what we are really asking is, why should the act of borrowing and lending, or the decision of how much to borrow and from whom to whom this relationship should go, why should that affect the overall macroeconomy? Now, to illustrate why finance was sometimes missing from the macro models, let me give you a very simple illustration. One common way macro models start is by assuming what we refer to as a representative agent economy. What does that mean? That means that if we are trying to model the macroeconomy, we can assume as if we can summarize the activity within that economy by a representative agent. So one household that represents kind of the average behavior of all the households in the economy. It's obviously, and everyone understands that's a simplification. It turned out that even with that simple assumption, we could say a lot about how various kind of shocks might propagate through the economy and so on. But one downside of this particular assumption, to give you an idea about the blind spot of macro, was that assuming representative agent implies that you have kind of taken finance out of the picture. Because remember, finance is the act of borrowing and lending, and you need at least two people to introduce the concept of borrowing and lending. But if you have a representative agent, the same person cannot borrow and lend from him or herself. So this is just one example of how, by definition, macro models would kind of ignore questions of how finance might impact the macroeconomy. Another consequence of this tendency of macro models to work with representative agent models was that the questions of distribution across the economy and the question of heterogeneity within the economy, the very fact that people can be very different in terms of their tastes, but also importantly in terms of their wealth and how much they choose to spend, those differences are not modeled if you start with an assumption that people can be summarized by a representative agent within the economy. And so one of the points that we try to make in this paper is that it's actually extremely important to focus on that heterogeneity, to focus on that distribution across the economy in terms of who owns how much income people have, how much wealth they have, that the distribution of those variables, income and wealth, actually turns out to be very important for understanding the overall business cycle fluctuations of the economy. Okay? And inequality, of course, is big in news these days. So you can see that this book naturally connects with that broader discussion of inequality as well, and it tries to connect the question of inequality with this question of why do we go into a recession and what are the best ways to get out of recession and so on. Okay? Make sure I know how I'm doing on time. Okay, so the third important theme in this paper, not in this paper, in this book, is that we have a tendency to theorize too much sometimes, and then to argue based on those hypotheses that we have built in our mind that this must be how the world works. We very actively push against that kind of an approach in settling debates which matter to us from an economic perspective. So in particular, the focus of this book, and in fact the focus of our research throughout, has been very much empirical. And so for any given question. So if you take the big debates, for example, should we do fiscal stimulus, is it going to work or not, or is the real problem in the economy more in terms of uncertainty, policy uncertainty, and so we need to reduce policy uncertainty first, and fiscal stimulus is not going to work. Well, as an economist, we understand that there is no right or wrong answer to these kind of questions, because one can certainly postulate conditions under which fiscal stimulus will work, and one can also postulate conditions under which fiscal stimulus will not work. And this often, I would say almost always, turns out to be the case, that theoretically it is important to postulate the different mechanisms and to postulate very clearly the conditions under which a particular theory will hold true. As a practical matter, it remains a question of empirics, a question of data, to figure out which of those hypotheses is more likely to be accurate at a given point in time for a given situation. In other words, without data, it's almost impossible to take a strong policy perspective. Now, this unfortunately is not stressed as much, and oftentimes people in the popular press at least take ideological positions based on their priors without forcing those priors through the lens of data to see, okay, do those priors actually pass the test of data or not? What we try to do in the book is we try to take the various hypotheses very seriously and look at the data to see, okay, which of these hypotheses is actually borne out in the data. And one of the questions from that perspective, from a policy perspective, turns out to be the question of how much should we help the homeowners in the event of a crisis like the one we saw in the US versus the banks. That became a big political debate as well. One can think of various scenarios in which the banks are the appropriate place to intervene from a policy perspective, but one can also think of situations where it's actually the households, the homeowners who may be underwater, who are the relevant agents to intervene from a public policy perspective. Which place to go to, then one has to look at the data to really answer that question. And so that's the kind of analysis that we try to do in this book, and I'll give you some of those results in today's talk as well, but obviously not everything, because I want you to read the book at the end of the day as well. Okay, so this is the philosophy that we follow in terms of the focus on data, which is given by the famous detective Sherlock Holmes. So when we gave our talk in London, this particular quote was especially appreciated. All right, so what's the connection? Now let me come to kind of some of the answers that we find in this book. What is the connection between debt and the macroeconomy? The basic point to keep in mind from that perspective is that the presence of debt, we've already seen some basic connections, right? The higher the level of debt, the more likely the economy is to go into these cycles of deep recessions, right? So there must be a reason that debt makes it important for the economy to have these large fluctuations. And we try to isolate those reasons, those channels. In technical language, we can summarize those channels as saying that debt has some general equilibrium macro externalities that the private market is not going to internalize. Okay, that's a lot of jargon perhaps in one sentence. I'll try to explain that a little bit more slowly. But what that basically means is that the act of borrowing and lending, at the end of the day, those are private decisions taken by private agents, right? Private banks decide how much to lend. The loan officers are taking in loan applications. And when they are making those decisions, they have some objectives. It's like profitability. They have some concern about defaults as well. But while they incorporate those factors, profitability and default, into their decision making, there may be certain macro effects, macro consequences of their individual decisions that they may not take into account. That's what we refer, in economics, we refer to those as externalities. So one issue that we highlight with debt is that debt, and we show empirically those externalities, that debt has certain macro externalities that will not be taken into account by those private agents. And as a result of those externalities not being taken into account, there can be excessive buildup of debt in the economy. Okay? Now that is an important point to keep in mind, because when we turn to the end of the book, which thinks more broadly about policy moving forward, one needs to take these externalities into account. Because if these externalities are severe enough in terms of potentially hurting economic growth going forward, then we need the policymakers to intervene in different ways. This is the classic argument, for example, for taxing smoking, like not allowing smoking inside buildings, because it imposes externalities. The person, the passive smoker, also his or her health will also suffer if someone decides to smoke. That's a definition of externality, and so we then have a reason for policy to intervene. So similarly, if there is an important externality from the macro perspective driven by debt, then that results in a different policy prescription that we can talk about towards the end. But let's now focus on what these negative externalities are that are driven by the presence of debt in the economy. To illustrate these forces, let me start with a very simple example, where I'm basically illustrating the mechanical consequences of borrowing and lending. So imagine a borrower who has $200,000, who's buying $200,000 house, and he or she chooses to borrow half of that money through debt, through a mortgage contract, and the remaining 50% she puts in as her own equity. So the starting point for this homeowner is that she has $100,000 in the house as her own equity, and the remaining $100,000 in the form of debt or a mortgage contract. So that's a very standard contract that, of course, millions of homeowners went through in the US. Now, the key point in terms of debt is that once you have this kind of a relationship, in the event of a financial shock, and in particular in the event of a downturn in house prices, how does that shock get translated to the borrower, which is the homeowner, versus the lender who's giving this mortgage? To think through that example, let's imagine that house prices decline by 40% in this economy. That might happen for various reasons, and one of those could be that, animal spirits, there might be a bubble in the housing market, and then there is a correction and house prices fall as a result of that correction. Let's work through the logic of what a debt contract does. What a debt contract does is that in the event there is a downturn, and in this case the downturn is represented by a fall of 40% in housing value, it will be the borrower who is forced to bear the entire loss on the downside. And so in this example, the borrower's equity will fall from $100,000 to $20,000, so the entire $80,000 decline in the value of this $200,000 home will fall on the shoulders of the borrower. And the borrower's wealth will decline by $80,000 in this example. The important point to keep in mind here is that the lender has not suffered at all. The lender's initial claim of $100,000 on this home remains intact. So the lender has not suffered in this relationship as a result of this decline in house prices, but the borrower has been forced to bear the entire loss. Okay? Now, given a 40% decline in house prices, you might say, so what? This is what they willingly got into as in terms of signing up this contract, and they knew that if house prices fall by 40%, they're going to lose $80,000 on their home, and that's absolutely correct. But the important point to keep in mind is that while they lose $80,000, somebody had to lose $80,000 because the house price has fallen by $80,000. The fact that it's the borrower who loses $80,000 has very different implications for the macroeconomy, as opposed to a counterfactual world where this loss was distributed more evenly across the borrowers and lenders. Okay? And I'm going to show you some results that make that point more clear. But first of all, let's look at the consequences of the US having that high level of debt, which meant there were a lot of borrowers who got caught in this situation when the housing crash happened in the US. So now let's look at the actual balance sheets of households in the US. So this chart comes from the Survey of Consumer Finances that tells us what people owe and what they own on their balance sheet, on the asset side as well as on the liability side. And the entire US is distributed in 5 equal bins. So from the poorest 20% to the richest 20%. And what you see in this graph, the 2 points that I want to emphasize in this graph. The first one is that in terms of the overall borrowing, it's the poorer section of the society that tends to have more leverage on their balance sheet. That is to say, a larger share of their balance sheet is borrowed from the banks, which in turn is money coming from the rich segments of the population because they have excess savings. Okay? So this is like saying when we talk about someone with 80% leverage, that person is more likely to be on this end of the distribution as opposed to this end of the distribution. People with more cash in their homes are more likely to be on the richer end of this wealth distribution. It's kind of obvious, there's no big puzzle there. The other important point to keep in mind in this graph is that not only are the poorer sections of the society more levered, i.e. they have borrowed more to purchase a given asset they have, but the asset portfolio is also biased in the direction of housing. Another way to say that is that on the asset side, their main asset is the house that they live in. And they don't own much financial assets in addition to the house. So they don't have many bonds, they don't have many stocks. House is primarily what they own, number one, and number two, they have purchased that home by leveling up a lot. Those are the 2 important points that I want you to take away from this graph. Okay? Now, given this picture, given this distribution of balance sheet in the economy, what is going to happen when this economy all of a sudden faces a downturn in the housing market? As I said, perhaps because people were too exuberant before. When this economy gets hit with a fall in house prices, that fall in house prices is going to result in very unequal distribution of those losses. Precisely due to the example that I gave you before. Those mechanics are going to kick in, so who's going to suffer most of the losses in proportional terms? Well, the losses are going to disproportionately fall on the segment of the population that owns those houses, but owns them by borrowing a large fraction of the value of those homes, right? So they have a levered claim on the housing sector. And that's exactly what you see in the data. So when you follow these households over time, and you compare, for example, the bottom 20% versus the richest 20%, you can see that the hit on the net wealth or the balance sheet position of the poorest 20% was much larger in proportional terms than the hit to the balance sheet position of the richest 20% in the economy. Now, there should not be any puzzle here. This is how the economy is supposed to work in this example, because that's what we have. Those are the financial contracts. That's what we call debt. So there is nothing, this is a natural consequence of debt. It's not a unique position to be in. This is just a natural consequence of debt, that any negative shock is going to be distributed very unequally across the society. Okay? Now, at this point, you might say, well, this is not fair or so, but we are not trying to make any moral argument here, because this is a contract that those individuals willingly went into, and so they knew that what they were getting into. The economic point, however, is a little different, and it's a macro point that I want to put across. The fact that the losses get distributed unequally across the population, even if we are fine with that issue from a political perspective or an ethical perspective, the economic problem is that it translates into a much deeper macro downturn. Okay, let me say that again. The fact that those losses are more unequally distributed, and in particular they are being forced on the lower end of the income spectrum, that means that the overall aggregate decline in GDP is going to be much bigger. Why is that the case? So that's where this particular graph comes in. What we did in one of our research papers was we went and we actually looked at the marginal propensity to consume for rich and poor households separately. Okay, what is marginal propensity to consume? It tells us how much people cut back on spending when they face a dollar decline in their net wealth. So if you take two households and you force them to suffer $1 in losses or $10,000 in losses, we can ask the question, how will those two households respond in terms of cutting back on their spending? They're both likely to cut back if you force them with a loss in their housing wealth. But what we find is that they act very differently. And in particular, the poorer, so this is the income of those different households, the poorer the household is, the larger is their response. So for the same dollar decline in housing wealth, they cut back on their spending more. In other words, their marginal propensity to consume is much larger than for the richer counterparts. Okay? Now, given this result, let's go back to the graph that I was showing you before. Given this particular result, if you have any given decline in aggregate house prices in the economy, if the economy happened to have higher levels of debt, a natural consequence of that economy is going to be that decline in housing wealth is going to be concentrated on the segment of the population which is most responsive to those losses. Okay? So now the economy is going to respond much more strongly. If the economy has higher levels of debt, it is going to respond much more strongly to the same decline in house prices versus an economy that does not have as high a level of debt. Because the poorer sections, people with lower levels of wealth, they tend to have much higher marginal propensities to spend. Okay? Now, private agents, at the time they are making the lending and borrowing decisions, they don't take these forces into account. So that's one channel, that's one macro externality that is not taken into account at the time people are writing the debt contract. They're deciding how much to borrow from one another. So this is what we call the aggregate demand channel. Okay? The larger the level of debt, the stronger will be the reduction in aggregate demand, because those losses are getting concentrated on those who are most sensitive to those declines. The second aggregate effect of having a high level of debt is that once you have this decline in aggregate demand, that shock actually perpetuates further in the economy through the trade channel. And the basic story to understand that argument is that imagine people in California are the ones who are highly levered. So when house prices fall in California, people living in California are going to cut back on their spending. But what kind of spending are they going to cut back on? Well, they are first going to stop spending on what we call durable goods. So if they were thinking of buying a new car, they will not buy that new car. If they were thinking of buying a new RV, recreational vehicle, they're not going to buy that recreational vehicle. And so as a result, people who produce those goods are likely to get fired. And this is exactly what you saw in the early months of the recession in the US. So to give you one specific example, there was a plant in Indiana that was producing recreational vehicles. Employees working for that plant were some of the first employees to get fired. Even though households in Indiana never borrowed as much, they were not getting a big negative shock to their house prices. But because they were selling most of those RVs to people in California and Florida who had borrowed a lot and were now cutting back their spending drastically, people in Indiana were also getting fired. So that's the second negative feedback channel. The first is the spending, and then because of that lower spending, now people start getting laid off in areas that otherwise were not affected by the initial shock. And so that further exacerbates the overall economic situation. The third channel, which is also a consequence of debt, is what is referred to as the fire sale externality. So to understand this, we focused on two types of states in the US. There are certain states in the US which are called judicial states, and other states that are referred to as non-judicial states. So if you happen to live in a judicial state, then if you cannot make payments on your home, which might be underwater, the lender cannot evict you, cannot foreclose your home right away. They have to go through the judicial process. So you have to go through a court, a judge, before someone can kick you out and put your house in a foreclosure. If you happen to live in a non-judicial state, then the bank does not need to take you to court. The very fact that you are late on your payments, they can use that excuse to kick you out of the home and sell your home in foreclosure. The result of that was that if you happen to live in a non-judicial state, you were much more likely to get foreclosed upon, conditional on not making your monthly payments. Okay? Now, if you compare the judicial versus non-judicial states, what you find is that even though the house price gains in those states were very similar before the crisis, once the crisis hits, it is the non-judicial states that suffer a much larger decline in house prices compared to the judicial states. Now remember, it is the judicial states where it's harder to foreclose on a home. So these states have fewer foreclosures, and you can see that in the data. And as a result of having fewer foreclosures, house prices don't fall as much. What we see in this picture is this very natural consequence of debt. That when the debtor is in distress, it is the right of the creditor to seize the collateral, which in this case is the house, and sell that collateral in the market. Now, if there are only a few individuals that are in distress, it's not a big deal for the overall economy, because there'll be new buyers who can buy that collateral, and that will be the end of it. But when it's an aggregate shock, when it's a system-wide shock, that is when you have what we refer to as fire sale externalities. That the act of millions of people not being able to pay back their debt, which is again the consequence of debt forcing those losses on that subset of the population, the fact that they cannot pay back their debts anymore and are forced to kind of sell their assets in the market leads to a further reduction in the price of that asset, as you can see in that graph very clearly. So that fire sale externality actually makes the problem even worse, because now even more people are going to be underwater. That further depresses house prices, which further depresses aggregate demand through the spending channel, which in turn lays off more people, and you can see that this cycle kind of feeds on each other for a while. And these are really the destructive channels through which the presence of debt permeates the initial shock to the rest of the economy through layoffs, a reduction in aggregate demand, and we have a much deeper problem than we would have otherwise had if we did not have that high level of debt. Let me now quickly turn to some of the policy aspects of this book, and I'll just mention two, and then I'll take any questions that you have. One aspect of the analysis that we do in this book is that if you go through the analysis and you understand these channels through which the economy is being impacted, the natural question that comes up is, okay, given that this is what's going on, how should we react as policymakers? What's the right policy response to this particular problem? The standard response of the government, in fact, not just in the US, but when you look at the European crisis, this has been the response in Europe as well, because historically that's sort of what people have thought is the problem with debt, which is that once you have highly leveraged institutions that get into trouble, some of those losses get concentrated in the banking sector as well. So banks also start to face trouble, like you saw with Lehman Brothers, for example. So one possible policy response is that in the event of these financial crises, we really need to go and help the banking sector, because it's the banks who are in the process of credit creation. They have to make loans, and we want to make sure that banks stay healthy and they continue making loans, right? And the argument again kind of makes sense. if making new loans is very important, then we want to make sure that banks have the ability to continue to make new loans. And so in the aftermath of this particular crisis as well, the government had the big TARP stimulus, which it used to provide equity to the banking sector, and a lot of resources were devoted to make sure that banks continue to function and they continue to make new loans to households and corporations. Now, one can defend that policy at different levels, but one particular concern with that policy is that it kind of takes the view that if only the economy could continue pumping new loans in the system, we could have gone on. And nothing bad would have happened, or nothing bad to the extent that it did happen would have happened. The problem with that argument is that if you focus on the amount of leverage that US households were accumulating, it really went through the roof during the 2000s. So if you look at household debt to income ratio, you can see that this graph has a very steep increase from early 2000 until 2007. To make the argument that the entire problem is on the banking side is to kind of argue that we just want banks to keep making new loans so that the amount of leverage can continue to increase. That's just not sustainable. There's a point at which, beyond which, debt to income, higher debt to income is not feasible anymore. So that's one problem with that view, that there is a limit to how much you can solve the economic problem by increasing loan supply. Because there has to be a borrower on the other end who can borrow and have the future capacity to pay back that loan. In the case of US in 2007, there is quite likely to be the case that the US households that were the main engine of the economy in terms of consumption and demand, they had fully exhausted themselves, and you could not lend them more money because they did not have the capacity to pay back. This was actually the problem in 2007, not the other way around, that there was no one willing to lend to them. Given that it's the weakness of the household balance sheet that's the source of the problem, for reasons that I explained before, we argue that the policy response should have focused on that particular problem. And there are different ways it could have been done. But if you go back to the basic example that I gave you, the policy should have focused on redistributing the losses towards the creditors. And the way to do that is to restructure the underwater mortgages. And you can do it in different ways. You can extend the maturity of those loans. You can force the banks to write down some of the principal, for example. And the government had different tools, or you can subsidize some of that process. None of that are things that are very elegant, but that is what you have to do when you're faced with this kind of a situation. So that's kind of the immediate policy response that comes out, given the problem that the US economy was facing. Let me, in the very end, focus on the long-term solution. I was going to talk about Europe, but I don't have time. If there are questions, I'm happy to go into that. From a long-term perspective, this analysis tells us that there is a fundamental problem in terms of the financial architecture that we have. And this is not just true for the US, but everywhere around the world. The fundamental problem is that in the event of an aggregate downturn, the housing collapse was just one example of that. In the event of an aggregate downturn, the losses, given a highly levered financial structure, the losses get concentrated on a subset of the economy, and they don't have the capacity to bear those losses. And that sets in place those macro externalities that we talked about. So what you really need is, you need to move towards a financial system that distributes the losses, or that shares the risk more equitably across the population. Okay? And that means we have to move away from the standard debt contract that we have. So one illustration of how we can move away from that to continue with the mortgage example that we gave is what we propose in the book as shared responsibility mortgages. And given all of the analysis that we have, we work through the numbers to argue that if we had just this particular contract, we could have avoided a large fraction of the loss in GDP that the US ended up suffering from. Okay, so what are these shared responsibility mortgages? They work exactly the way our current mortgages do, but they have two important differences. The first one is, that in the event your local city house prices decline 10% or 20%, the by say 10%, your monthly payments also automatically go down by 10%. So it forces the lender to share some of the downside risk proportionately, right? Now, the important piece is that that's written up front. So you don't need the Congress to step in and say, enforce the issue. Everyone understands that's what's going to happen. So the losses are shared proportionately in the event of a downside reduction in house prices. Now, once you do that, obviously the lender is not making as much money as they used to under the current system. So that's where the second element of our proposal comes in, which gives the lender an upside to compensate them for providing this insurance. And in particular, we worked through the numbers to argue that you only need to give 5%, 5 percentage points of the net capital gain at the point of sale of the homeowner. So whenever you sell the house, whatever your net capital gain is after taking out closing costs and so on, only 5% of that net capital gain you are required to give back to the lender. If you do that, the lender is now fully compensated. So the ex-ante cost of capital remains the same as it is today. So the interest rate up front is not going to change under our proposal. But the important piece is that this alternative way of structuring our financial contracts, if we had this kind of a contract, we could have shared the downside risk more equally, and as a result could have prevented some of those vicious negative loops that I talked about. The reduction in spending, the employment losses, the fire sales externalities. We could have avoided those losses, and as a result the entire economy would have been better off. Okay? So this is similar in intuition to the argument that we say we want to mandate insurance, for example, when people drive on the road. Because if people are driving without insurance, they're going to hurt other people, and they might drive recklessly because they know they're not going to face the consequences or all of the consequences of their reckless driving. So we mandate that you pay the premium, that your premiums will go up if you drive more recklessly, to kind of discipline everyone who's on the street. And the same logic holds here as well. These decisions of borrowing and lending, they have wider implications. They have these macro externalities. And so we need policy to kind of guide those decisions in a direction which is better for the macro economy. Okay? So that's just for mortgages. The same principle can be applied for sovereign debt, for corporate debt as well, but the basic logic of the argument would remain the same. I'll stop at this point and open up for questions.
Can I just ask a clarifying question? When you say 5%, you mean percentage points or percent? Like if you made 20% on your home sale, would you be giving back 5% or 1%?
It's 5 percentage points of the net gain. So if the net capital gain is $10,000, it's just 5% of that. So the remaining $95 out of 100 of your capital gain you get to keep.
I'm a little bit confused about the forces that take place here. If somebody is in their home, they don't lose their job, how does the loss in property value in the marketplace impact them if they continue to make payments on the debt service?
So even if they, in fact, in the example that I gave you in the beginning, the person does not lose their house and they will continue to make their payments in that example. But even though these individuals, and there were millions of such individuals, they continue to make their payments, they are going to adjust in other ways. And that's important to keep in mind. In particular, because they have just lost a large chunk of their money in the house, they're going to cut back on their spending elsewhere. And that's the problem. So the fact that they continue making their loans is good for the bank because their portfolio does not go into default. But the overall economy still suffers because of the cutback in spending that they're going to do. And that is the important point for the overall economy.
If you could come to the microphones, please. You would like to give priority to the students?
Well, why don't you decide who asks the questions? It'll be easier for me, actually.
So please, if you want to ask a question, could you please come down to the microphone?
2 points, please. First, of course, there have been many bank failures throughout American history and world history that have resulted in economic collapses that had nothing to do with debt. So, point one, I'd appreciate some comments on that in terms of the ability to generalize this concept. Second, just comparing judicial versus extrajudicial or non-judicial states, ultimately, aside from the instantaneous market value of the property, the lender is responding, I think, to the anxiety and cash flow in their ability to relend the monies that are coming back on a payment scheme or payment plan. Because the ultimate value doesn't change, save from whatever the depreciation or appreciation may be. And so the longer they hold on to the property during the cycle, the more it will appreciate, and therefore they're going to be paid back in as much as they ultimately own the deed to the property anyway. So it seems to me this is an emotional response and a time-dependent response rather than a finalized position benefit.
So let me just quickly respond to the first point on bank failures. I mean, the broad literature, that's at least my understanding on bank failures, most of the bank failures are driven by a high level of leverage in the economy. If the borrowing firms, for example, have not borrowed a high level of debt in the first place, then they typically will not default on their obligation to the bank, and as a result, banks are not going to default. So typically, bank failures do happen at exactly the same time that the economy has high levels of debt as well. So there is this strong correlation between high levels of debt and bank failures. That's observation number one. Number two, your other question, I didn't fully understand the complete question, but one issue in these circumstances is that while it might make sense, and that actually turns out to be the case, that prices often drop way below their long-term value. And so if you have the patience and the ability to hold on to these assets, you will make up more money going forward. In fact, finance theory also tells us that the premium will go up, which is to say that the return to holding these assets is much higher. But the problem is that many individuals and institutions just don't have the ability, and that is the important point, to continue holding on to these assets in those times of distress. So in particular, because of the kind of negative cycles that I talked about, if people are losing their jobs, they don't have the ability to keep financing their mortgage, and so they will be forced to go into bankruptcy and to put their houses on the market, which will make the problem worse even for the neighbor who otherwise might have been able to sustain their mortgage.
I think at one point you mentioned that you wouldn't expect the interest rate charged by the banks to change. Can you just talk us through that, given that now it seems like the banks are actually bearing the risk of house price movement, so you would expect them to charge a higher premium on the interest rate?
So can you repeat the first part of your question?
I think at one point you said that you wouldn't expect the interest rate charged by the banks for mortgages to change.
Oh, yes.
Can
yes.
you just walk us through your reasoning?
Right. So in the proposal that we have, if you start off with the standard mortgage that we have, which is a 30-year fixed rate mortgage, we are making two changes. The first one is that banks are going to now automatically face some of the losses on the downside. So if house prices go down, they will make less money. All else equal, putting that loss on the banks will force them to increase the interest rate that they charge up front, because they need to compensate themselves for the insurance that they are providing you. So to avoid that increase in interest payments up front, we introduced this second component into those mortgages that we just talked about, which is that the bank also gets an upside. And it turns out that that upside only needs to be like 5 percentage points of the net capital gain. That upside is enough to bring the interest rate down back to the level that they are today, for example. And actually, this is one place where securitization can be very useful. because one problem with giving the upside is that if a bank is making a loan to an individual homeowner, they don't know exactly when that homeowner is going to sell. So there is some uncertainty, and as a result, there might be some risk premium that they demand because they don't know when I'm going to sell the house, and hence they're going to get back their net capital gain. But if they securitize across a number of different homeowners, we know on average around 5-6% of the homeowners, for upgrading or reasons of job mobility, they are going to sell their homes. So if you have a securitized pool of such mortgages, you're almost guaranteed a constant stream of coupon payments that are going to come from those 5% net capital gain. So you're going to receive that constant payment, which is going to put interest rates back down to the kind of the levels that we have today.
Thanks very much for speaking today. I'm wondering if you could talk a little bit about how your policy prescriptions or suggestions for mortgages, how this sort of interacts with home ownership policy. Because it occurs to me that, you know, one of the reasons that there is this institution that the government backs with a 30-year fixed mortgage is that there's an idea that this is, you know, a mass asset investment program. And this sort of preserves that, but sort of removes some of the potential upside for homeowners. And so I wonder, you've made some very radical proposals, but also but in some ways preserved the home ownership policy exactly as it is. And I'm wondering if you could explain how that works.
Right. So first of all, you're absolutely correct. In what I have said, I've deliberately tried to shy away from existing policies of home ownership in the sense that I'm focusing on the one change, which is on the risk sharing dimension. Having said that, I agree with you that the current subsidy that we provide through the GSEs for home ownership, there is no economic rationale for providing those subsidies. So those can be removed as well, but there is one big problem with removing those subsidies. Even though in the long run we understand those subsidies need to be removed, if you were to remove those subsidies today, so I'll give you one example. One big subsidy is through interest rate deduction that you get on your mortgages. So we are going to keep interest rate deduction in this alternative mortgage as well. The reason for that is if you were to remove that deduction today, house prices are going to fall dramatically, and even more so in places like California where they are, you know, much higher values and much higher levered homes. If that were to happen today, the economy is going to go into a deep recession. So we are kind of locked into that particular subsidy for now at least. The economy today is too fragile to move away from that subsidy. While I agree with you in the long run, as a first best would be good not to have that subsidy, but we cannot afford to remove that subsidy today because it will directly lead to a very sharp decline in housing values and most likely another recession.
Could you please elaborate on Europe? So in particular, should we have broken the banking view in Europe? Could we afford that, given the systemic risk of the banking sector in Europe and the sovereign bank niches?
Yes.
First, and second, quickly, if you could elaborate on sovereign converted COCO, so the equivalent of what you were proposing on house debt. Or I will buy the book on the second question, but if you have time to
yes.
elaborate.
So first quickly on Europe. The picture for Europe, and this is one way to think of that. If you think of the big collapse in Europe, and those countries, they all tend to be countries that had borrowed a lot, right? So this is just on the x-axis. Each dot is a country, and I'm sorting European countries by their extent of borrowing on the x-axis. So if you are further on the left, means you borrowed more during the boom years. And on the y-axis is their fall in consumption, the fall in demand in those countries. And so you can see the more you had borrowed during the boom years, the larger is your fall in consumption once the recession begins, right? And again, that is driven by the fact that if you had borrowed a lot more, given this decline, this slowdown in the European economy, a larger share of the losses kind of fell on your heads. And you cut back on your consumption much more drastically than in some of the lender countries like Germany, for example. So the pattern looks very similar across Europe as it does in the US. that we present in the book. Now, in terms of the banking system, we are not arguing at all that we don't need to have functioning banks. We need to make sure that the banks remain functioning. But the 2 points are important there. First of all, to maintain banks as functioning banks, you don't need to put government money into banks. You can force the losses that the banks have to bear onto their long-term creditors. So you can write down the value of their bonds on the long-term bondholders to keep the bank functioning, so the management stays on, but the losses are forced onto the long-term creditors of the bank. That's another way of intervening into the banking sector while maintaining the banks. The other point is that it still remains the case that the broader issue is that in the case of US homeowners, those are underwater homeowners, but here we are kind of talking about underwater European economies, like Greece, for example, which has too much debt on its head. It remains the case that you cannot shy away from that basic problem. And you have to restructure their balance sheet, which means you have to write down some of that bad debt, some of that underwater debt. And one of the basic problems with the European crisis has been that that reduction in bad debt was not large enough and was not done swiftly enough. And so the focus was more, let's save the banks, but keep the kind of the level of the debt the same on those indebted economies. That is just not feasible from a macroeconomic perspective.
I'm curious, empirically, for the number of foreclosures that occurred, what percentage of those had a situation where the homeowner had negative net equity? And also,
almost all.
Almost all.
Almost all. Because
So
by definition, you can imagine if you have positive equity in your home, you don't need to foreclose. You can just sell that house and pay back the bank.
So in that situation, even if home prices were to fall by a large amount and their payments were divided in two, wouldn't most of the foreclosures still exist? And also, I'm just curious, according to this policy prescription, for the 5% upside in net capital gain, how long payments would be divided in two for once that negative 10% occurred in home value?
So it turns out that if you proportionately reduce the monthly payment for 1% reduction for a 1% decline in house values, by definition, no homeowner would actually be underwater. Because actually, that was one important detail I didn't give you. While we reduce the monthly payment in the event of a downturn in house prices, your amortization schedule remains the same. That's actually a very important point. What that means is that when you make your regular monthly payments, your principal keeps going down, right? If house prices go down by, let's say, 10%, your monthly payment will go down by 10%. But the rate at which your principal goes down will remain the same as it was originally stipulated in the contract. What that basically means is that if house prices remain low at 10%, you will make 10% fewer payments and still pay off your mortgage over, let's say it was a 20 year, over the 20 years that you had promised before. So it's effectively a principal write-down. If house prices were to remain low by 10%, it's as if your principal has been written down by 10 percentage points. And so there is you're never going to feel underwater, because if the house prices remain low, then I'll just make lower monthly payments and yet pay off my debt in the same amount of time that I had originally promised. So no, there is no such thing as an underwater homeowner in this proposal that we have. And so you avoid the foreclosure problem as well.
Still, nonetheless, though, if you have 10% down and your home falls by 50% and it stays there, there's no way to recapitalize or recapture that.
But you're not going to be underwater in this particular example, because if your home goes down by 50% of value, your mortgage payments forever will also go down by 50%. But you will still pay off the original loan at the same pace. So it is as if 50% of your original principal has been written off. You're not required to pay that anymore. So that's why you're not going to be underwater.
Thank you.
Just one question about the mix between monetary policy and this type of contractual changes that you're talking about here. I mean, the coordinated effort of all the central banks, I guess, in the world has been to, put a lot of massive amount of liquidity at the disposal of the bank, and that had an effect of drastically reducing the nominal interest rate and even,
Yes.
and maybe the real interest rate to negative. That allows also a mechanism of refinancing at a very much lower cost. How do you compare that to your policy here, which is actually contractual changes? And what's the good mix between the two in order to achieve the minimum downside of a post-debt crisis?
So monetary policy tries to do what you just described, but the problem with monetary policy is that it is actually not very effective in these circumstances. And the reason for that is, first of all, notice that the problem really is in this end of the distribution. This is where the underwater homeowners are, right? When you lower the interest rate, you want these homeowners to take advantage of that by refinancing their homes. But precisely because they are in financial distress, they are unable to do that. So that's one way through which monetary policy actually fails, because they are the ones who need it the most are unable to refinance their homes. That's one of the problems. The other problem is that monetary policy does actually redistribute, but it redistributes in the wrong direction. And that is a consequence of the fact that, think of the upper end of the distribution. Who are the lenders to the other end of the wealth distribution? They are the ones holding these long-term bonds, 30-year mortgages and so on. When interest rates go down, it's the value of those bonds that goes up, along with stock market and so on. All of that wealth sits here, all of that financial wealth sits on this end of the spectrum. So these people, so net wealth, aggregate wealth actually, you might see that recovering very quickly because of monetary policy, but it's going kind of in the wrong hands from a spending kick perspective. Because these are the individuals, are precisely those individuals that have the lowest marginal propensity to spend. So monetary policy is affecting their balance sheets the most, but that's where it has the lowest kick back into the real economy. And that's one of the problems with monetary policy as an effective tool. Okay.
Hi, thank you for speaking. So my question deals with how the banks will respond to your proposal. I mean, I get it, I like it, but without sort of thinking about, say, a reduction of risk in the long term, what are the incentives aside from the 5% sort of upside, and how would, say, a banker argue against such a proposal? And also, I guess, more abstractly, are there any reasons why the possibility of an underwater mortgage is a good thing, and why should we remove it?
So I'll answer. So it's a very good question of how to incentivize banks to kind of accept these kind of proposals. So you need government intervention in terms of changing the incentives of banks to write these kind of mortgages. There are two large obstacles to that right now, which needs to be removed. The first one, and I've already talked about that, is the interest deductibility of mortgages or debt in general. Because interest paid is tax deductible, it is only tax deductible if the instrument is legally defined to be debt. So the moment you introduce this kind of risk-sharing arrangements, it does not necessarily qualify legally as debt, and hence the payments that you make do not qualify as being tax deductible. That's a huge subsidy that goes in the wrong direction. It favors debt as we have it, and any such innovation will face that uphill task of having to convince the borrower to not have the subsidy and yet be willing to take on this mortgage. So that subsidy needs to be removed, number one. Now, given the other stuff I said about the housing market potentially crashing if you remove the subsidy, what we propose is that you keep the subsidy but switch it over to this kind of a contract, because it has better risk features. So the full proposal actually is you take out the subsidy from the existing kind of debt that we have and move it over to the shared responsibility mortgage that we have. This will kick in an incentive from the borrower side to demand these kind of mortgages. On a related note, the 30-year fixed mortgage that we have right now, that's not a market, it didn't evolve out of a market mechanism. It was actually promoted through the government, GSEs and so on. And so we need kind of the government to come in and coordinate on this new security that we argue needs to be introduced into the market. The second important point from the perspective of government intervention is that there is another regulation that also biases contracting against the kind of proposals that we are making in this book. And that has to do with capital regulation. So under existing capital regulations, if banks hold fixed liability claims, so AAA securities, for example, on their books, they don't have to put up much capital against that. But if they were to issue the same mortgages, but not as conforming mortgages, but as what we are calling shared responsibility mortgages, they would be forced to put up a lot more capital than they currently have to do. Now, this actually is unfortunate because the shared responsibility mortgages actually have better macro risk features than the existing 30-year fixed rate mortgage, and yet the regulation in place is actually incentivizes the banks to make the wrong kind of mortgage. So these are two of the tax and this capital regulation. These are two important places where we are actually incentivizing the banks to make the wrong kind of mortgage, and that needs to change, and that obviously has to come from the government.